Welcome all of you to this wonderful conference. The school is very excited to receive you here. I know that there are scholars from several very important centers around the globe, from Vanderbilt, from COPED, from Tilburg, our partner in other adventures, from FAIR, our School of Economics and Administration at USP, and other colleagues from FGV. It is really a pleasure to receive all of you here today. I learned from my colleague, Erika Gorga, that is organizing this conference, that a very famous corporate law scholar has once said that public securities markets involved a kind of magic. As a constitutional lawyer, this was a very impressive phrase for me. But I believe that we are all here to challenge in some way this magic. We know that behind this fascinating, rare magic, there is also something that is not magical, but still fascinating. Strong capital markets are based on a complex institutional framework and its underlying legal rules, which play a major role in mobilizing economic surplus to the formation of productive capital. Indeed, in most developing countries, capital markets have become a relevant tool for economic growth after the privatization era of state-owned enterprises, which happened in Brazil during the 90s. In this regard, we could say that Brazil, despite its bank-centered financial system, had achieved a relative success in public securities market by the time of subprime crisis. For instance, the São Paulo Stock Exchange, the BMF, Bovespa, designed in 2000 a dual regulatory regime for listed companies based on differential standards of corporate governance practices. Measures as such, we aim to foster the capital market by increasing minority shareholders' protection and, consequently, reduce agents' costs to private benefits of control. Unfortunately, as we well know, the crisis in 2008 slowed this advantage of this competition between securities regulators. Strong academic research in comparative financial regulations and corporate governance, as the ones that will be presented in this conference, provide us with useful insights on how to understand and cope with the crisis, as well as to improve the capital and financial markets for better finance and liquidity of Brazilian corporations, and therefore for enhancing economic growth. So DIREITO GV is thrilled to host this conference on capital markets and capital and financial markets, post-crisis developments, and welcome the professors from the United States, Europe, and Brazil that come here today. Well, this school was created in 2000 in a moment that Brazil counts with more than 1,000 law schools. Perhaps Brazil is the country in the world who had more law schools. From what I know, US has around 220 law schools. India has around 600 law schools. Mexico is a country with a lot of law schools, but still with much less than 1,000 law schools. So we really didn't need another law school. We needed a new law school, a law school that would cope with the challenge of a country that was in a complete change in the 90s and in 2000. Brazil was changing rapidly. Economy, opening, demand, more competition. And as we all know, competition does not take place only at the level of economic actors, but also at the institutional level. A well-designed institutional setting, wisely operated, is fundamental to create a trustful environment, and that is what we aim at. So, the mission was clear. Our law school should be able to contribute through the renovation of legal teaching and research to the social, political, and economical development of our society. This mission was carried out through the strong leadership of our Dean Emeritus, showing on the left, Ari Osvaldo Matos Filho, and a vibrant group of young and unorthodox professors that he brought together. Multiple innovations were introduced: full-time professors, interdisciplinary approach, problem-solving, student-centered, and case-method were some of the tools that oriented this school to become an independent research center. In this aspect, today is a very special day for DIREITO GV. We are very pleased to officially announce the launching of our Center for Law, Economic, and Governance. Again, our school reaffirmed its commitment to interdisciplinary legal scholarship, focus on relevant policy, and cutting-edge research in the area of capital markets, banking regulations, and corporate governance, as well to promote the public discussion and dissemination of the knowledge in the field of law and economics. The center is co-directed by Professors Erika Gorga, Bruno Salama, and Mariana Pargengler, which we are very proud to have at this school. One of the privileges of being a dean is that you're invited to open conference where you have very little knowledge about it. Before I start to say nonsense about the areas that you are all very knowledgeable, I would like to thank you, to stop here to thank especially Professor Randall Thomas from Vanderbilt, Professor Joseph McCarthy from Tilburg, and my colleague Erika Gorga to put this meeting together. I also would like to thank Professor Aloysio Pessoa de Araújo from EPGE, our sister school at GV, for his kind acceptance to provide the keynote speech for this conference. I also would like to mention that we are very proud that in the audience, Maria Helena Santana, the former chair of Brazilian Securities and Exchange Commission, is here. I know that she will bring a lot of knowledge to this conference. So I wish you a great conference, and thank you again to be here. Erika, the floor is yours.
Good morning. So to celebrate the launching of the Center of Law and Economics and Governance, let's get started as soon as possible. I would like to introduce you Professor Margaret Blair, who is going to give a speech to us. She has got her PhD from Yale University and has taught at Georgetown University Law Center and is now a professor at Vanderbilt Law School. Please, Margaret. And Professor Armando Castelar Pinheiro is going to make comments to her presentation. Professor Armando got his PhD from the University of California, Berkeley, and is coordinator for the studies of applied economics at IBRI from Fundação Getúlio Vargas, and also professor from Federal University of Rio de Janeiro.
Okay, good morning to you all. It is, you notice I said you all. I'm from the South of the United States, so it's a great honor for me to have a chance to talk to you today and to listen to you and hear the other speakers of the day, and I hope also to hear from even those of you who are not on the program, that we get questions and interaction, and to meet you during the break. So the paper that I want to talk about today is something that I've been working it's one of 3 or 4 papers that I've done that I'm working on some of the same topics. And it's my attempt to try to understand what was going on at the time of the financial crisis that helped to trigger the problem. Because if we don't know what caused it, it will be more difficult to prevent it from happening in the future. It was devastating to our economy in the United States. There were a number of economies that survived rather well. Brazil, as I understand it, didn't get caught up in the financial expansion and perhaps didn't suffer as much on the downside. But when the leading economies in the United States and Europe collapse in the way that they did in 2008 and 2009, this is not good for anywhere in the world. The entire world suffers from that. And so trying to understand what caused that has led me to focus on something that I've come to call private sector money creation. So I'm going to talk about making money today. We all would like to make money, right? But we need to know, when we do that, what is money? When we say we all want to make money, we mean we want to get wealthy. But money performs an important function in an economy, and it is a unique kind of component of the capitalist system. Money can be a medium of exchange, okay, such as gold. It's a lubricant that helps to facilitate commerce. Money can also be a claim on an underlying commodity. Okay, so that in the early years of the United States, banks one of the things that traded as money in the economy were certificates that were claims on gold. Okay, you could take them to a bank and exchange. Many banks held gold in reserve. You could take your certificate and you could exchange it for gold. Sometimes the government issued these, and sometimes the private sector issued these. It could also be something we call fiat money, which is something that the federal government issues that is not a claim against any hard metal or other commodity, but it's simply a government-mandated unit that can be used to settle debts. The government creates fiat money in 2 ways. It can issue deposits to the banks, and then the banks can then have those deposits to expand on them, and I'll say a little more about that in the future. It can also simply print currency, and currency is not exchangeable for actual commodity, but it is deemed to have value in and of itself. So how is money made? We'd all like to know how to make money, right? Well, the standard textbook story about how money is made, at least in the United States, where we have a central bank, and I think this is pretty much true around the world now, is that the central bank deposits money in banks. So it injects money into the system by creating reserves in the banks. The banks then can then make loans, and as they make loans, this causes the money supply to expand. Now, implicit in this story, I'll say a little more about that, how that works in a minute. Implicit in this story is that the Federal Reserve can have a reasonable amount of control over the money supply. The Federal Reserve determines how much bank reserves it puts into the system, and it also determines the required reserve ratio. So how does this work? If the Federal Reserve puts say $1 million into a bank, okay, in the form of reserves, that bank, if we have a 10% reserve ratio requirement, the bank must hold 10% of that in the bank, and it can loan out $900,000. It can loan out 90%. And if it loans out 90%, the recipient of that loaned money then can deposit that in that person's bank, and now that bank has $900,000 in new deposits. And so it can turn around and loan out another 90% of that. So the second bank can loan out $810,000, okay? The recipient of that $810,000 deposits that into a bank, And now that bank has additional deposits, which then it can loan out, again, 90% of it. And if you add all of that up, you play that out through the economy with a 10% reserve requirement, the $1 million that the Federal Reserve originally put into the system can become $10 million worth of new money in the economy. Well, so can money be made in any other way? And the answer is that we think of the federal government as, which makes the fiat money, it makes what's called high-powered money. High-powered money is currency, which for purposes of this conversation, we're going to sort of ignore. Plus, it is the reserves that the Federal Reserve injects into the banking system. In addition to the federal government or the Federal Reserve Bank's act of making money, okay, banks make money, and they do so by extending credit, and that has the multiplier effect that we just discussed. Bank lending is not completely constrained, however, by reserves, okay? If banks could issue other kinds of liabilities, it could acquire funds with which to make loans, further loans. And so the reserve requirements may not be the factor which is most constraining in terms of how much new money the bank can create. If banks can raise money in other ways, like by, for example, issuing CDs or borrowing money in the money markets, which we're going to say more about in just a minute, then it can expand beyond what would be what would result simply from the reserves injected by the Federal Reserve. And we've seen that, in fact, banks in the United States have done that. This is the ratio, measures the ratio of the of credit market debt. This is money acquired by banks, raised by banks in ways other than simply accepting deposits or reserves. Okay, that ratio relative to the total assets of the bank has been increasing, and it increased it very dramatically right around in the last 4 or 5 years before the financial crisis. So banks began dramatically acquiring assets and acquiring assets with which to make loans themselves by going into the credit markets and borrowing in the same way many non-financial institutions can borrow. Okay. So although this raises the question if you can make money in effect by raising funds from the money markets and not simply through issuing deposits, then could non-banks do this same thing? And what happens if these non-banks engage in extensive credit market transactions? Well, non-banks, they're not allowed to issue deposits. It's the ability to issue deposits that defines a bank, okay? But they can issue other short-term liabilities, such as money market funds, commercial paper, repos. The total value of such non-bank credit market activity has been called shadow banking, and that activity grew to exceed the amount of activity in the banking sector in the years immediately prior to the financial crisis. And here's a measure of, this is a measure of the assets in the shadow banking part of the economy relative to assets that were in depository institutions or traditional banks. And as we can see, that activity began to grow really fast back in the, this is around 1980, okay? And around 1980, this activity in the non-banking, or what came to be called shadow banking part of the economy, began growing quite fast. And in the years immediately prior to this is about 2000, okay, 1999, 2000. It began growing dramatically fast. This line, I don't know if you can see this, but this line is 1, so a ratio of 1 means that the shadow banking sector was as big as the banking sector. It got quite a bit bigger, and then it collapsed. That is the shadow banking part of the economy is what collapsed very quickly when the financial crisis got underway. So is there any constraint on how much money shadow banks can create. Now, notice I've expanded my definition of money. I originally said I've included something now that wasn't on that a list that I had at the very beginning. I am now using thinking of money as securities that have a very, very short-term termination date. They act almost like a medium of exchange, as my colleague Morgan Ricks has written about. They're referred to as if you look at most of the accounting treatments in many corporations, the assets that they have that are in these very short-term instruments are often simply referred to as money, or cash and cash, what's the other term? Cash and cash equivalents, right. So they're cash equivalents. Thank you. Okay. Now, what this means is that the total amount of money, of cash and cash equivalents in the system at any point in time may now be controlled more by the activities in the private sector than it is by the activities of the government authorized Federal Reserve Bank. Non-bank institutions or the activities of non-bank institutions consistently in the last 10 or 15 years has accounted for pretty much this. We saw in that previous figure, it amounted to 120% of what the banks were doing in the lead up to the financial crisis. It's now down to less than around about 80%. But nonetheless, it's a very substantial portion of what's going on in the economy. Now, one of the constraints on how much that banks can put in, as I mentioned, was something called the reserve ratio. You get outside the banking system, and what constrains the non-banks in terms of how much additional money they can flood the economy with is their capital ratio, or the degree, said the other way, the degree of leverage that they use. Okay, leverage in the shadow banking sector is not regulated. In the banking sector, banks must meet something called capital requirements, which means the amount of equity they have to have in their balance sheet. Okay, in the non-bank financial sector, they do not have to meet that requirements, and so it is only the market that may constrain how much debt they can take on, and therefore how much of this near money or cash equivalents they can actually take on. So the problem with this, potentially, is that this can be highly unstable, what the non-bank part of the financial sector is doing. Take, for example, a financial institution, I won't call it a bank, okay, that is constrained either by regulation or by the markets to holding 10% of equity in their balance sheet. Okay, that institution can take $1 million worth of equity, and they can make loans, or they can borrow an additional $9 million to go with that they can borrow it on a long-term basis or on a short-term basis, but in the money markets they tend to borrow it on a short-term basis, and they can support a balance sheet that's worth $10 million. Okay, well, suppose that the required capital level, or the opposite of the leverage level, it goes down, and that they are now permitted to hold to have only a 5% capital ratio, or hold 95% of their balance sheet in debt. Well, if we follow Modigliani-Miller would tell us that what would happen is they'd swap out $500,000 worth of equity for debt, and now they would have a balance sheet that would still support $10 million in assets, but it would be funded with $500,000 in equity and $9.5 million worth of debt. Okay, what happens instead? Okay, or it appears to happen instead, is that the bank takes that, or the institution takes that $1 million worth of equity, okay, and borrows now $19 million to support that, so that they can now support a balance sheet with $20 million in assets. Okay, well, is that a problem Well, what it means is that imagine what would happen then if they were only required to hold 2.5% of their balance sheet in equity. Well, then they can now support a $40 million balance sheet. So what happens is out in the tail of the activity, a tiny percentage point or two change in the amount of equity that the institution is required to hold can cause huge swings in the size of the balance sheet that they can support. Okay, so that what was happening in the lead up to the financial crisis is that we had what are the shadow banks operating with extremely high leverage. So these are data that I put together on the leverage in the banking sector and the leverage in the non-banking or shadow banking sector. So we find that the banking sector operated at a leverage ratio of around 94% historically. Okay, in the 1980s in the United States, some of you may be aware we had a savings and loan crisis. Okay, and in resolving that crisis, the leverage ratios in the banking system as a whole were taken up to a tri-type hit 98%. Okay, they had under enormous pressure from the regulators after that to bring the leverage ratios down, and they did. And over time now, the banking sector operates with somewhat less than 90% leverage. Meanwhile, however, the non-banking sector, okay, was expanding its leverage and learning more and more ways to use issue repos and other kinds of things. Oh, I see. You want me to use that? No, if you don't mind, I'll just, can everybody hear me? Okay. The non-banking sector has been allowed to operate with leverage ratios between 98 and 100%. Okay, so then imagine the size of the balance sheets that they can support, at least in theory, when they can operate at leverage ratios that are that high. So but then, of course, after the financial crisis, these shadow banking firms were then required to reduce their leverage or to sell off a bunch of debt, reduce their balance sheets in order to correct the problem. They had to pull an enormous amount of credit out of the economy in order to achieve that. So this is a measure of activity in the shadow banking sector, okay? And it shows that the blue, the darker blue, is the assets of what are called GSEs, government-supported institutions, or government-supported entities. Okay, so this is the Fannie Mae and the Freddie Macs. Okay, these are the big sort of government or the big institutions that had kind of an implicit government guarantee that were supporting the mortgage market. Okay. They were growing throughout the period leading up to the financial crisis, but meanwhile, we had several other categories of non-bank institution in the shadow banking sector rapidly expanding their balance sheet up until 2007, okay? And then they began, the non-government institutions began rapidly having to deleverage. And as they had to deleverage, they had to pull assets out of the system. And you can see a substantial collapse in the in the non-government supported shadow bank sector. Okay, the government supported sector was expanding its balance sheets as rapidly as it could to offset that. Okay, but they couldn't offset the system as a whole was losing an enormous amount of value. Here's another look at the same thing, and this is a chart put together by my colleague Morgan Ricks, and he divided the world into, he looked at short-term securities issuances. My numbers were looking at the institutions, and he looked at the kinds of securities they issued. And the red numbers are private sector security issuances, issuance of securities with very short-term duration. No, duration is a slightly different concept, so that's why. Okay, what? Yeah. Okay. The blue portion here are sovereign money. So this is sources of short-term securities issued that are very short-term, that including currency and Federal Reserve balances insured deposits that have the backing of the federal government. So again, you see a very rapid expansion in the private sector money creation, okay? When the private sector money creation began to collapse, the government portion began increasing as fast as it could to try to offset that, but they couldn't increase fast enough to offset the decline that was coming from the private sector. So the question is, how much money is too much, okay? If the private sector is creating money, okay, how much is too much? In the United States, we hear a lot of criticism of the Federal Reserve because they have been expanding the money supply rather dramatically through the quantitative easing program since about 2009, okay? But these efforts by the Fed to expand the money supply, the phrase quantitative easing means to expand the amount of the quantity of money that is out in circulation. But the Fed's effort has continued to be offset by what was going on in the private sector, okay? So I have another chart which I borrowed from, this is one from a private data collection, a private consulting firm which assembles data on government numbers and tries to, in some cases, they think, this organization thinks, improve on the government available numbers, okay? What you see here is M1, this is the portion of the money supply that the Federal Reserve has some degree of control over. It was actually coming down in the years leading up to the financial crisis, okay? M2 is a broader measure that includes mostly bank-created money, but money in the form of, say, longer term CDs and that sort of thing, okay? And that was certainly not growing at an intolerable rate in the years leading up to the financial crisis. It showed a little bump up at the time of the financial crisis, and it's come down. And there hasn't been a whole lot of activity in M2. Where the action was in M3. Well, M3 begins to include some of those things, but not all of the things that I counted as part of the shadow banking sector. It's starting to pick that up. The federal government, the Federal Reserve stopped measuring M3 in 2006, okay? They simply decided it was not a relevant number anymore, and they stopped measuring it. So this private organization continued to collect the data and try to estimate, develop their own estimates of M3. It shows it exploding in 2007 and 2008, and then just collapsing very rapidly. But M3 encompasses both M1 and M2, so whatever the Federal Reserve was trying to do to try to push money out into the system in the form of M1, the private actions in the private sector were more than offsetting that, so that the private sector money collapsed. So how do we know how much money we should have in the economy? And we don't know. Well, unfortunately, we don't know that. What we know is that, however, is that in the last 3 or 4 decades, the ratio of money, if you only count M1 and M2, in the economy relative to GDP has declined, okay? It was accounting for less and less or being used to a lesser extent in activity. So M1 went from 16% of GDP in 1978 to 10% of GDP in 2007. M2 went from 60% of GDP in 1978 to 54% of GDP in 2007. Meanwhile, however, activities in the activities in the financial system as a whole, if you measured by the total amount of credit in the economy, went from 2.9 trillion, or 125% of GDP in 1978, okay, to 36 trillion, or 259% of GDP in 2007. So when I first began playing with these numbers, someone said to me, well, that's because the U.S. may be funding a lot of activities overseas. and I don't have the data with me right now, but that's actually the U.S. is neither a net borrower or lender overseas. It lends a lot overseas, but it also borrows a lot overseas. And so that turns out not to be an explanation for why the total amount of credit in the system is now twice as much relative to GDP as it was 30 years ago. So one question you might ask is, well, why did the Fed stop measuring M3? Okay, it seems like M3 might have been quite informative. In fact, I'm not the only one that has made this argument. There are several people out there who have said the Federal Reserve should not have stopped measuring M3. What it should have done is start to measure even broader measures of the money supply that we might call M4 or M5. Okay, the reason it stopped measuring M3 was that in the last time we had a substantial, it wasn't treated as a monetary crisis at the time. The problem was inflation. Coming out of the 1970s, the U.S. economy was experiencing very high levels of inflation. To get that under control, the Federal Reserve under Paul Volcker dramatically slowed down the rate of growth of the money supply. It got inflation under control. It caused a substantial recession in the United States. But as we grew out of that in the 1980s, the economy seemed quite strong. After that event, the Federal Reserve reported, at least, that the relationship between money aggregates and GDP were too unstable, that it didn't make any difference, and that following trying to predict the economy on the basis of the size of M1 or M2 or M3, apparently they thought was not telling them very much. My own view of this is probably they were missing the action. The action was going on in the private sector. They should have been trying to measure M4 or M5 rather than discontinuing their measure of M3. Okay, so since that time, the Federal Reserve has basically focused on controlling interest rates rather than controlling the money supply, except for the quantitative easing program that's been going on in the last 3 or 4 years. So what are the implications of all this? We know that M1 and M2 didn't provide any warnings that the asset bubble was forming. M3 might have. If we'd been following M4 or M5, we might have seen the asset bubble forming and been able to do something about it. My own view is that the monetary authorities need to re-embrace the task of measuring and monitoring not only bank-made money, okay, Federal Reserve made money and bank-made money. They also need to be following more closely what's going on in the private sector in the way of private sector money creation. My other piece of this is that a huge portion of that is driven by the leverage ratios that these non-bank institutions are allowed to create. The Dodd-Frank Act and the latest developments from the Basel Committee have focused on adding capital to the banking system, but they have not focused on reducing the leverage ratios in the non-bank shadow banking part of the system. So thank you.
Shall I start? Shall I start? Thank you. Let me start by congratulating the law school in GV in São Paulo for launching the center. I think it's was overdue that we have a center like this, and I'm very confident, given the quality of the professors, that it will be a great success. And let me also congratulate Professor Blair for a very interesting paper. I'll try to be brief on my comments so we can have more discussion. Let me start by summarizing how I see the paper, what I think were the main points, and then go more directly to my comments. I think the paper has 3 main points. One, that there was too much leverage in the US, and I think we can easily extend the paper's conclusion to Europe, at least to Western Europe, but also some of the former communist countries such as Hungary and other countries, the Baltic Sea countries, Iceland and others. There was too much leverage in the financial sector, and this was, in a sense, the main reason for the financial crisis that lasts to this day. I think the second point was that regulators failed in keeping leverage down, particularly in understanding the role being played by the shadow bank, by off-balance sheet vehicles, SIVs, other conduits, and that had been created. And as Professor Margaret showed, there were much more leverage than the banks themselves, and there was, as she shows in the paper, the wrong view that these vehicles were independent of the banks that created them, so that there was a lot of risk diversification in the sense that these assets were held ultimately by investors worldwide. And so there was the risk was not with the banks. Formally, it was not indeed. But at the end of the day, they end up being, they went back to the balance sheet of the banks due to problems of reputations. The bank were concerned of that. In some cases, there was, it was not discussed in the paper, but as I recall it, there was some cases that banks had also guaranteed credit lines, and there were sort of indirect guarantees that were also important reasons why the bank put these vehicles back on the balance sheets. And the third point, if I understand correctly, she sees the post-crisis changes in regulation is insufficient to correct these problems of leverage and particularly off-balance sheet instruments that are used to, in a sense, game the rules in a way that allowed the financial system to keep more leverage than would be recommended by good policy. I think it's hard to overemphasize the importance of these issues, either as leading causes for the crisis or for the current discussion on regulation and economic policy in general. Obviously, as you discussed it then, this is central to the discussion which is going on with the Basel Committee on the Basel III agreement, which is gradually being implemented most countries, including Brazil. And I think it's also critical to discuss problems that we find in other countries that apparently didn't learn enough from the U.S. experience. And I have in mind what's going on in China, where the shadow banking is a main issue being discussed, and now it's very large. Worse than in the case in the U.S., even the government doesn't have good statistics on how large it is, or who is implicated. And I think the government is not taking enough care to limit it, concerned as it is that this could bring a more critical slowdown. Actually, I think some of this slowdown that we're seeing in China this year and the government's acceptance to have a lower growth is linked to the desire to limit the expansion of this shadow bank. But again, I think there's a lot that has to be discussed about that. I took note, though, to a number of points that I think were also important reasons for the crisis and also important lessons that I think were underemphasized in the paper. So I put them for Professor Margaret to discuss. One, she mentions that were wrong, that the incentives for traders and managers in the financial systems were wrong. But I think there were also wrong incentives in loan origination. So there was like one of the main discussions in the Dodd-Frank Act is that that originators should keep more of their skin in the game, so they just pass along. I think there's a large discussion in Basel III about liquidity requirements, not only leverage requirements. So I think it's very important. I think we learn with this crisis that liquidity has to be also measured at a system level rather than just an institution level, because when everybody tries to sell liquid assets, they find out that liquid prices collapse, and that also has implications for solvency, which the way that I think the regulation was seen before the crisis, that, you know, and she mentioned that in the paper, is that as long as you went institution by institution, you did the right job. Now there's a perception that you have to keep this macro-prudential, so this is being called rules too. I think another thing that I missed in the paper is that I think a lot of the problems were, one, very peculiar to the U.S., and two, were that in the U.S. you have so many regulators doing the same thing, as opposed, for instance, in Brazil. And that a number of the problems appeared in institutions that managed to operate in the cracks between regulators. And so there was not that regulation was per se insufficient, for instance, regarding leverage, but that there was nobody actually responsible for the institutions that were to leverage, and that's where the problem was. And critical among this were the brokers, which actually were the most leveraged institutions in the system, and Bear Stearns, Merrill Lynch, Lehman Brothers. They were not regulated as banks. They were regulated by the SEC, the U.S. CVM. So they were perceived as non-bank investment banks, but they were not regulated in the sense that they didn't have demand deposits, so they were not under the oversight of FDIC. They were not constrained in their leverage, the ability to lever in the same extent. So it was not as much that bank regulation was not well put, but that actual banks, were not regulated as banks. And I think a major problem with these institutions were, and I think again another lesson of the crisis, which was very much into what was put into the Dodd-Frank Act, is the issue of connections. These companies were found to be too connected to fail. Not they were too big, they were actually very big, but they were too connected. So in the case of Lehman Brothers, for instance, nobody actually knew which were the trades in which Lehman Brothers were involved in. You know, so I mean, it was like they had to close. They had to find out about, you know, all these derivatives that Lehman Brothers was on one side or the other of the trade. So again, there was connection, and this led to all these regulations requiring derivatives, more of the derivatives to be traded in exchange rather than over-the-counter transactions. Another major problem I think was found, and which is in Basel III, is the fact that asset valuation is dependent on which part of the cycle you are in. You know? So when the economy is booming, there's a lot of credit, assets are worth a lot. So they showed up in the balance sheet as the bank being very well positioned. When you revert the cycle, you find out these assets are not worth that much. So the whole solvency equation of the bank changes very much. So Basel III has this adjustment that will require more capital when the credit is booming. Now, it's funny because at the beginning of the crisis, I went to Spain and to the Bank of Spain to learn about this cycle, just because they had this kind of provision, and they were seen at the time as very prescient regulators, and now we know that the Spanish bank system is totally broken. You know, so I think there are, I guess, limits to what you can do. But anyways, it's more on how you implement than about the idea. I think we do need the kind of cycle adjusted capital requirements that Basel III requires from banks. Another fact that I think is missing in the paper, and I think was very important in the crisis, was that there was a lack of good resolution institutions in some cases. And again, this is the cracks of the regulatory system in the U.S. It's that things that wouldn't have happened in Brazil, for instance, where the regulatory system is different. So you have the two very different cases of Washington Mutual and Citibank. So Washington Mutual was relatively easily, it was a very large institution, I think. It was one of the largest banks, thrift actually, in the U.S. Again, another regulator, not a bank regulator, but a thrift regulator. No? Again, that wouldn't happen in Brazil. It's same regulator in the case of Brazil. So in the Washington Mutual case, the problem was at the bank, and there was very little at the holding company. So once you solved the bank, the problem with the holding company was there was no problem. You know? So you intervene in the bank, the bank, the Washington Mutual was absorbed by J.P. Morgan, and life continued relatively at low cost. You imposed costs on holders of debt by the holding company of Washington Mutual. There were actually one of the few cases in which actually senior creditors actually suffered a loss for their bad investment decisions. It was very different in the case of Citibank, which should have had the same kind of solution. It was a larger bank, but the main problem was that if you intervened at the Citibank, which was under the oversight of the Fed, you would leave the holding company of Citibank with all the derivatives. There were a huge number of derivatives that would make bear shares pale down to the amount of interconnections that Citibank holding company was involved. But the Fed could not intervene at the holding company. It had no mandate to intervene in the holding company. So it could solve the bank, but it could not solve Citibank, Citicorp. No? And so there was a lack of power to intervene. So the problem was there. Everybody knew what should be done, but there was no legal institution that allowed the regulator to intervene at the holding company. Again, this is something we changed with Dodd-Frank Act. And I think Professor Margaret just mentioned there were, again, cracks in the financial system that allowed companies such AIG and Freddie Mac and Fannie Mae, and there was a number of federal housing banks too, which I think to some extent had the same problem, to take very poor investment decisions. Now, insurance company, in particular the case AIG, is very tricky in the U.S. in the sense that most of the regulation of insurance is done at state level. The federal government has very little power to regulate insurance companies in the U.S. And so we got this very large insurance company, which is an international, multinational insurer, that we started to do this. If you read that book, The Big Short, Michael, it's very interesting. I'm telling how AIG was critical in allowing for synthetic CDOs. Not only you were securitizing mortgages, actual mortgages, but you started to simulate them with CDS. And you wouldn't have been able to do that about AIG. So the part of the book, the guys, it's like, who's the sucker who's holding this risk at the end of the day? So it's AIG. So, but nobody was regulating AIG. So again, it was not that regulation was bad, but there was no regulation. And again, this is very, very specifically the case of the U.S. Same thing with the Fannie Mae, Freddie Mac, which was these institutions that government-sponsored entities, but nobody actually knew what the kind of liabilities the federal government had with them at the end of the day. So again, I think there's more to the crisis than just leverage. A small note here that I took note: shadow banking was regulated in Spain. So and still, as I mentioned, didn't prevent them to go into the mess that they are in. So trying to go into a conclusion here, I think one of the things that I missed most in the paper was some kind of formal prescription as to what would be the socially right, the socially correct level of leverage. It was too much, but then what? Since the early days, we know that the main problem with the banks is that they get the wrong incentives from leverage. That's the main reason why you have bank regulation to start with. As the paper discussed, you get the wrong incentives because the shareholders get all the benefits in the good days. If the project goes well, they share the losses disproportionately with the bank, with the depositors in case the project doesn't work. So this is critical to bank regulation. So there need to be controls on leverage, but then if the controls that were there were not the right ones, then what were the right ones? If I understand correctly in the paper, there's a view that Basel III doesn't do the job, but then what would be the right ones? Professor Helwig from the Max Planck Institute has a very drastic controls. He thinks that banks should not be able to leverage more than 4 times. And that's not adjusted for risk, that's total assets, you know? So, and you still have those narrow bank guys that think there should be no leverage at all, you know? You should only be able to lend your own capital. So, you know, in between all these, I mean, what's the right number, you know? What should we do? At some stage, you use the 1980 as a benchmark for what will be the right size of the financial sector. I think this is, again, too drastic. As I think you mentioned now in the presentation, the U.S. is a international financial center. The Brazilian corporates issue in New York and the U.S. I mean, that has nothing to do with leverage in the U.S., but that also contributes to the financial sector being large in New York and the U.S. So that big curve, is that bad? One minor point before I finally wanted to conclude. I'm pretty sure the IMF has the data on M3 and M4 for the U.S. I think it has data for everybody.
Who has it?
IMF, the International Monetary Fund. So I think it keeps the statistics for all countries. And if IMF doesn't have it, OECD probably does it. So I suggest that you look at this to other sources. And to conclude, I think a point that you may want to discuss, I was curious after reading the papers. What do you think are the implications for developing countries of all this quantitative easing in the U.S., Japan, England, the Euro area? It's certainly leading to some of the main similar problems that you pointed out in the U.S. Now, I think leverage increases certainly in Brazil. Asset prices are booming. I was in Istanbul 2 weeks ago, and people are trying to convince me that 800% rise in real estate prices in the Golden Horror is okay because it's a small piece of land. You know, exactly the same thing about Rio de Janeiro and Ipanema without the Olympics. Although they're trying to have the Olympics there 2020. You know, so they may end up with the Olympics explanation sometime. Do you think that this quantitative easing policies should be reverted? I think you think that people in Brazil who complain that we are being adversely affected by these policies, is that right? Right, that's thank you.
Yeah.
Thank you again for the invitation.
Thank you. So these are very helpful comments, and they're also asking the big questions. And I recognize that my paper doesn't answer questions, but it seems like a lot of the research and the policy pronouncements that I've heard in the last 4 or 5 years seem to me weren't even asking the right questions. So I wanted to focus on this one phenomenon. The discussion even in the publications that have come out of Basel, there's been a lot of talk about bank capital, but again, they focus on it as if the bank capital is an issue because of the riskiness of the individual institution, and not because there's a kind of aggregate effect from the use of leverage. And so what I was really trying to do in this paper is simply point out that you get an aggregate impact of the use of leverage that can be highly unstable when it gets up to very high levels, A, and B, but when it's in the private sector where there's a termination date in the bank, and somebody's going to have to make good on those loans at some point. I was talking with my colleague Morgan Ricks the other day about one big difference between money created by the private sector and money created by the government is the money created by the government doesn't have a redemption date. And if you get to be a crisis, they don't have to suddenly pull it all back. They can leave it out there. In fact, they can pump more money out there if they need to, whereas this private sector money creation, it's all in the form of very short-term debt. It has a termination date, and at some point, they're going to have to pull it back. And so that creates that instability when you're operating at very high levels of leverage. But the other points you make are absolutely right. I'm not in any way taking those back, but that's what I was trying to achieve in this paper, is to just focus on that one issue. And then do we have time for questions, or what's our schedule? Who's?
Later on
Okay.
in the morning for questions.
Okay. So that's all I have. Okay. Thank you very much, then.